What's up, traders? What's up, tycoons? Super excited for today's video. As always, the content provided on this channel is for informational and educational purposes only and is not intended to be relied upon as legal, financial, or investment advice. So please be sure to read through the full disclaimer. Now, nominal GDP growth is elevated, right? We're going to get straight into it today. And, you know, this is something that's pretty important right now. All right. I just covered recently the Atlanta Fed Now's GDP forecast, and it's much higher than the top 10 and bottom 10 range that analysts were forecasting. It's almost double, as high. So, we're going to see if the Atlanta Fed now is right or if some of these analysts are right. But this nominal GDP growth being so elevated has been one of the main contributing factors leading to this right here, which is the most soft landing stories since 2008. Now, why is this important? Well, we all know what happened in 2008, the great financial crisis. And essentially, this is story counts on recession and soft landing. And so you have soft landing in black, you have recession here in this orangish color. And you can see, you have the peak here in, recession, right, during the great financial crisis, 08, 09. And, we're seeing a record lows here in searches and, story counts with the title recession in it. And then you have soft landing here, just hitting massive, massive highs, right? Hitting highs that it's above 1999 levels, right? Which is right before the dot-com bubble, ironically. So is this something to worry about, right? Is this something to panic about? Usually let me know in the comment section. All right. I just kind of want to give you guys a thesis of, behind why we're seeing some of this stuff. Okay. Now, even with this soft landing really trending, we're seeing that overall positioning is down sharply, driven largely by discretionary investors, even as systematic strategy positioning remains elevated. So, if everyone's talking about a soft landing, why is overall positioning down sharply? Well, if you take a look here, this is the stock return on an EPS beat in blue, and this is the stock return on an EPS miss here in red. Now, NVIDIA is going to be an outlier, right? NVIDIA obviously skyrocketed after its earnings report. We'll see where it opens up at in the morning. But we're seeing a 0% average stock return on EPS beats right now, which is pretty wild. But basically, companies aren't being rewarded for beating earnings. And there's many factors, for this. One of the main factors was because of the tremendous rally that the market already experienced, right? When the Nasdaq is up tremendously and the S&P 500 is up tremendously in the first half of the year alone, one could say that a lot of these, earnings expectations were already priced into the stocks beforehand. And so depending on how much they beat by, or if they barely beat, they're not really being rewarded, right? And so some people are really shocked by that. And when you take a look at the stock return on an EPS miss, it's down about 3%, which is on the lower end of the range, right? The only time it's exceeded that is around 2017, 2018, and also 2019, based on this data set going back to 2012. All right. Now, another reason why we may be seeing lower positioning is due to the volatility index. And so, I love volatility, the VIX, the VVIX, the VIX 9-day, the VXX. Okay, I track all of these different, volatility indexes. And this is where we are here. Okay, and so what we're looking at and how you read this data set is basically the bottom axis is your trading week of the year. So 52 weeks, right? We're over here in the latter half, and you can see that the VIX, which is going to be your average VIX progression here. All right, this trend line. And then you have the VIX long-term average. This is where we start to get back above that long-term average during this time period. So, September historically is probably one of the worst months for the stock market. Now, that doesn't mean that we have to have a bad September. Okay. There's lots of different things that could drive the market higher in September and actually see a positive September. But if you're looking at historical data, it kind of makes sense why, maybe positioning is actually going down right now, heading into September and heading into this period where volatility in the VIX index typically starts to rise throughout this period. And then you see in the last half of the year, right, from 40 basically to 52. So essentially the last 3 months of the year, let's call it, all right, averaging 4 weeks a month. So October, November, December, we see a sharp decline in the VIX. And this is something that I'm taking heavily into account, right? Me personally, I'm basically planning on a really big movement up in the stock market and in certain equities and certain stocks through that October, November, December period, based on different seasonalities and cyclical data that I've been studying. Now, overbought conditions meet overhead resistance. So I forget who this chart is from, but you know, it's pretty basic at the end of the day when you take a look at it, right? You have the overhead resistance right around that 4,600 range. We hit that overhead resistance, and then this is a 13% premium to the 200-day moving average. So this is something that I thought was pretty interesting. But this is another way to kind of measure overbought, right? A lot of people typically use the RSI. If we were to just draw a resistance line here, you can see that really since June, the market has, kind of been in these overbought conditions here, trading, above a 10% premium, usually a 10% premium. We saw what happened in the market here. We had a significant decline from 4,800 all the way down to 3,600, right in that range. This is also the time of Jackson Hole. Jackson Hole is fast approaching. A lot of people are worried that Jackson Hole is going to actually crash the market yet again. We'll have to see if that's actually the case. Now, the S&P downgrades multiple U.S. banks citing tough operating conditions. The S&P Global on Monday cut credit ratings and revised its outlook for multiple U.S. banks following a similar move by Moody's, warning that funding risks and weaker profitability will likely test the sector's credit strength. S&P downgraded the ratings of Associated Bank Corp and Valley National Bank Corp on funding risk and a higher reliance on broker deposits. It also downgraded UMB Financial Corp, Comerica Bank, and Key Corp, citing large deposit outflows and prevailing higher interest rates. I actually just put out a really amazing newsletter on this. If you guys don't know, I have a completely free newsletter giving you guys different trade ideas and setups. And, it's not just for trading, right? It's also actually covering really good and important topics in finance. And I did a really good newsletter on, basically the financial sector, and, just a brief summary of, what we're looking at here. And, you guys, again, it's free, so you can actually go back and read this. Just click the link in the description or comment section down below. It's definitely worth the read. What we have is the XLF SPY ratio chart up here. And then we have the actual S&P 500 index right here on the bottom. And you can see that since the great financial crisis, the XLF has pretty much gone nowhere when you look at this ratio chart and performance compared to the SPY. And then you take a look at the SPY. I mean, it's like, is it even worth it investing into the financial sector? I've never been a big fan of investing into the financial sector. I try to dip my toes into PayPal in 2022. And I'm sure you guys can imagine how that worked. Definitely had to sell that one for a loss and cut those losses. And, the more that I try to research them and look them up, it's just like, I mean, if something hasn't moved in almost 2 decades, in 15 years relative to the S&P 500, I'm not sure that that's something that I want to own. Then I also break down some technical analysis on them on the daily time frame, the weekly time frame, as well as diving into more data inside of there. So if you guys are interested, all right, it's a completely free newsletter. This is what the website looks like. All of the newsletters are uploaded to the website as posts, so you can go back and read them at any time. And it's completely free to you guys, right? Try to put out free, valuable content on YouTube, and now I'm expanding that to a newsletter business. Now, monetary policy has a 15-month lag, and this is important. All right, we're going to highlight why this is important here shortly. And you can take a look at this chart here, and it also has the 10-year, 3-month Treasury yield spread on there. There's different Treasury yield spreads that people like to look at. The 10-year, 3-month is one of the more important ones. And when we move forward, we have to remember that there's a 15-month lag, right? So what we're going to do is we're actually going to draw a vertical line, and we're basically a year out from the first Fed hike. Okay. And when you take a look, or I'm sorry, this is a month following the inversion. Okay. So, the Fed fund rate has that 15-month lag. Okay. The yield curve inversion also has a lag on, the effects on the economy as well. And so what we see is that the 2022 inversion has yet to see a rise in unemployment. Okay. And that's what we're looking at. Here's the labor market. But you really start to get these spikes closer towards that 15-month period, right? By 15 months, that's when you really start to see an acceleration up. And so that's something that we really, really need to keep as a potential scenario heading into the future, right? Is that 3, 4, 5, 6 months from now, things may look a lot different in the economy. And so while things seem good right now, and it seems like inflation's being tamed, it seems like the labor market's holding up. Again, we really haven't seen the effects truly of the Fed fund rate hikes, and we haven't really truly seen the effect of the yield curve inversion. And again, once you take a look 14 and 15 months out, that's when the labor market, seems to be a little less resilient, and that's when we start to see that rise in unemployment. Now, household debt burden remains low today. Again, we haven't really felt the effects of the yield curve inversion. So if monetary policy, okay, and the yield curve inverting is going to hit the economy, then that's when we're going to start to see that rise in the labor market. That's when we're going to start to see the rise in the household debt burden. And if you take a look here at the implied interest expense for corporate bonds, corporate interest payments are about to rise. This is the interest expense exped. It's in this, slightly shaded one here, but the implied interest expense is actually skyrocketing up. And this is basically, done by factoring in Moosen's CDB corporate bond yield to the stock of debt. And that's essentially how you come up with this data right here. So, lots of things to potentially be concerned about. Now these aren't going to be black swan events. They could, potentially turn into black swan events. And right now they're not a major crisis to the economy or to investors, but there is potential there, right? If the labor market, and unemployment really start to, skyrocket up, that's going to be tough on the economy, right? We're seeing, those elevated GDP levels right now. If unemployment starts rising, we may not see that elevated GDP in those really high GDP forecasts that the Atlanta Fed now has. If corporate interest payments are really about to start hitting hard, as this data set suggests, then that also could be very tough, especially when you look at the commercial real estate sector. And then you start taking into, account that a lot of them are going to have to refinance some of this corporate real estate. And, with how high interest rates are and how high treasury yields are right now, that potentially could be a problem as well. And businesses have not felt the rate hikes yet. This is the non-financial corporate interest paid. And you can see it's just flat here, right? And what they did was a lot of these corporations, they did something smart, okay? And they actually locked in massive amounts of debt here in 2020. And that's why you've seen it flatlined, is because, they still are paying, the very low rates that they locked in years ago during COVID, really taking advantage of that low interest rate environment. And eventually some of that debt is going to need to be refinanced. All right. Some of that is going to come to maturity or so on and so forth. And, any new type of debt, there's definitely a lot of these businesses are going to feel it. Okay. They're going to feel the actual rate hikes, once they actually go to refinance or take out new debt. Now, this is existing home sales. Now people are going to tell you that this is bullish because existing home sales are going down. So they're going to tell you that this is going to lead to bringing inflation down. That could be the case, right? And that could be a bullish thesis. But if we really see this thing start to break down, that potentially could be a bad sign. Okay. We don't necessarily want it going back to these 2010 levels here. And we don't necessarily want to see the housing market crash or collapse. Now, that may depend on who you're talking to. There may be a lot of people who are waiting on it for it to crash so they can finally get into the real estate market. But in general, people aren't really wanting to see the price of their real estate go down, right? And they're not looking forward to some massive crash or some massive correction. Now, this is just existing home sales. This isn't like the price of homes, okay, saying that, the prices have, shot down. But this is just going to be another important data set that you guys want to keep an eye on and pay attention to. Now, I mentioned Jackson Hole previously, just recently actually in this video. This is the S&P 500% S&P 500 percentage change after Jackson Hole. Okay, and you can see it dropped down 12%. This is the 10-year treasury rate. You can see it actually rallied up to 3.69%. So, it went from basically 3% up to 3.69%. That's the TNX, the 10-year treasury. And then you see the SPX, the S&P 500 drop about 12%. This is something that people need to, keep in the back of their mind, right? This doesn't necessarily have to happen again. And this doesn't have to play out the same way. Oftentimes, Jackson Hole is really just a big nothing burger. But with so much attention on it due to what happened last year, you need to keep in mind that if Powell comes out a little too hawkish, or he says some things that, whether the bond market or the equity markets don't like, there is that potential for another sell-off in the markets. Now, that could go the opposite way too, as well, right? He could say, hey, you know, we've raised interest rates, a good amount. We've raised the Fed funds rate, a good amount. Maybe we're just going to leave it here for a while and not do any more rate hikes. Right now the market's pricing in one more rate hike, not at the next meeting, but, later in the end of the year. And then the market is actually pricing in rate cuts in 2024. And so if he was to come out dovish, then maybe he would say, hey, maybe we're done hiking, and maybe we're actually looking at potentially cutting in 2024. The market loves to hear what it expects, right? It loves to hear what it expects. So if they're pricing that in right now and pricing in rate cuts in 2024, and he suggests something like that, then the market's going to rally, right? Because it's the news that it expected, it's the news that it wanted to hear, versus, the market doesn't like surprises, right? And it doesn't like shock. And if he comes out and shocks the system and shocks the market, it's very possible we could see treasury yields rally, and we could see, the equity markets start to drop. That's it for today's video. Appreciate you guys watching. Smash that like button, subscribe to the channel for more. I drop videos like this every single week, along with technical analysis on, the bond market, commodity markets, cryptocurrency, individual stocks, as well as much, much more. I also, want to remind you guys about that free newsletter. It's really good content coming straight to your inbox, completely free. So you don't have to worry. It's completely risk-free to you. We all love a risk-free trade. So I'd say take a shot with this, and sign up using the link in the description below or in the comment section down below, and help support the channel.